There you go. You're good.
Thank you.
Uh-huh.
All right. So I'm Josh with Academy Mortgage, but I think Brian knows who I am.
Yeah, we have a new agent, Kristen, in the office here.
Oh, okay. Hi, Kristen. So I may have met her today at the headshots as well.
Yep.
Okay, great. Well, so what's a jumbo loan? So a jumbo loan is a mortgage used to finance properties that are too expensive for a conventional conforming loan. So a jumbo loan is a conventional loan. However, it is not a conforming loan. So the conforming loan limit for most counties, and especially in Oregon, is $548,250. So $548,250. As soon as you get to $548,251, you are now into jumbo loan territories. That county loan limit is set by the FHFA, the Federal Housing and Finance Agency. So what makes a conforming loan? A conforming loan at that limit is guaranteed and backed by Fannie Mae and Freddie Mac. Once you go over that amount, there's no protection anymore for the lender. So 100% of the risk becomes the lenders and the investors. So whereas if you have a conforming conventional loan, if the borrower were to default, then that risk is shared by multiple parties. So the lender, the investor, Fannie Mae or Freddie Mac, a mortgage insurance company, if one's involved, but risk is shared. And so as a result, the underwriting guidelines for a conforming loan are often not as strict as they may be for a jumbo loan due to that risk sharing. Once you get into jumbo territory, whoever the investor is on that loan takes 100% of that risk. Some highlights that we'll talk about are credit score, debt to income, cash reserves, what type of documentation are you going to need, appraisals, down payment, how interest rates compare to that of a conforming loan, and as well as costs and fees, and loan limits, because jumbos, although they are anything over the 548,250, different programs will have different loan limits as well, based on the investor. And then we'll take a look at some example programs. All right, first, let's talk about credit score. So may require your FICO score to be higher than a conforming program. So a conforming program, conventional loan, technically you can go down to as low as a 620, albeit once you're down at those lower levels, rates, costs are generally going to be a lot higher. Maybe difficult to get that loan approved depending on the reason why the score is lower. But for a jumbo loan, and you'll see it in some of the examples I'm going to bring up later, but the credit score requirement is generally higher. 680 is generally the lowest that you're going to see a typical conventional jumbo loan that'll be allowed. Many are 700 or even 720 and higher, depending on the program. And that may be a little bit of a sliding scale as well, depending on how much you're putting down, cash reserves, so on and so forth. And you'll see that again in some of the examples later. Debt to income. So if you don't know what debt to income, DTI is, it's your debt to income ratio, which is the amount of usable gross monthly income divided by your monthly debts. So your credit debts, things that show up on your credit report, your auto loan, student loans, credit cards, and of course your mortgage payment. And you have two two stacked ratios. You've got your front end ratio, that is what your gross income is divided by what your mortgage payment is. And then you have your total debt to income, which is the mortgage payment plus all of your other credit debts. So it doesn't take into consideration your cell phone bill, your water bill, that kind of thing. Only things that generally show up on your credit report. Sometimes other things may be included as well. And then cash reserves. Cash reserves are something that's going to be required on almost every jumbo loan product. And those cash reserves, if you don't know what cash reserve is, that is the money left over after closing. So if you've got $100,000 and you're going to use all $100,000 for your down payment and closing costs to buy your house, and you don't have any funds left over after closing, then you don't have any cash reserves post-closing, and likely would not qualify for a jumbo product. So you want to take that 100,000 and figure out where it's going to be best utilized. Maybe you need to find, maybe you need to put less down so that you have enough left over for your cash reserves to satisfy the lending requirements. And depending on the program, those requirements could be cash reserves as low as 6 months to 30 months, depending on sort of the loan program in general. And when I say reserves and base it on months, that's based on your mortgage payment. How many months of reserves do you have left over after closing in mortgage payments? So if you've got a $2,000 a month mortgage payment and you've got $8,000 left over, then you got 4 months of reserves. Just sort of for some simple math there. And that's per home you own also. So if you own multiple homes, then that reserve requirement is going to be based on every home that you own and the monthly payment. Any questions on this screen or any of these items? All right, we'll move on. Documentation. What documentation are you going to need for jumbo lending? So it's the same stuff you're going to need for your conforming loan and more. So on a conforming loan, often you can get away with just pay stubs, maybe not even a W-2, or you can get a VOE, a verification of employment from your employer. You generally need to hit, one of the items in those buckets for a conforming loan, and you can, often get it approved without the other items. With a jumbo loan, you generally need everything. You're going to need your W-2s, 1099s, tax returns, current pay stubs, verification from your employer, all your bank statements, more than 2 months. Generally, if you're self-employed, you're going to need more. So basically, just to say that the documentation needed for jumbo loan is often much more robust than what you would need for a conforming loan, and making sure that your clients understand that up front, which is something that I as a lender make sure that they do, is important, so that you don't run into issues later, especially once you're under contract, trying to get the proper documentation or having not reviewed the proper documentation up front, which could cause a problem later. Certain jumbo programs have very specific documentation requirements, and they are non-wavering in those requirements. There may be common sense to do the loan, but if they aren't meeting those specific documentation requirements, then it's unlikely that that particular program would approve it. Appraisals. So your appraisals are going to be really similar to that of a conventional loan. Depending on how much the loan is, however, a second appraisal may be required. That's not uncommon for loans over $1 million, $1.5 million, so on and so forth. As mentioned prior, the risk is 100% on the investor and the lender for these types of loans. So they may require a second appraisal to make sure that they are getting the best unbiased value possible for that property. Down payments. So down payments is often a question that I'll get on on jumbo loans. What is the minimum down payment we can go, so on and so forth. There's obviously no maximum down payment. You can put down as much as you would like over the minimum. So, well, of course, until you get to a conforming loan limit. So low down payments are, really common with conforming loans. So FHA, you can go as low as 3.5%. Conventional, you can go as low as 3% down, whereas with jumbo loans, typically you have to bring in more. 20% for a lot of programs is required. Some may go as low as 10%. We have a 5% down program, although there is a loan limit on that as well. And I have that included in one of the examples below. So yes, you can go as low as 5% down in some for some programs, but 10% down for others. And then after that, 20% down, sort of depending on how much you want to do. Any questions on this? Okay, so interest rates.
How typical
Oh,
are jumbo loans?
how typical are jumbo loans?
Well, so they're definitely more typical in our
Especially
current market.
here, right?
What's that?
Especially here.
Yeah, so it depends on a little bit depends on the region you're in, the area. So our, conforming loan limit is now 548,250. If you go to what's called a high priced area like Seattle, their conforming loan limit is higher. It's in the 700s. So we've been doing a lot more jumbo loans this year as a result of the home appreciation that we've been experiencing. And so utilizing some of the great programs that we have, we've been able to help a lot of folks to it. However, by and large, the still lion's share of the lending that's going on out there is conforming conventional loans under that limit, even though we have seen an uptick in them and they are more common. Sometimes if it's close to that loan limit, instead of doing a jumbo loan, we may do a first and second. So we may do a conforming loan at the loan limit of 548,250, and then the borrower will do a second loan, HELOC, home equity line of credit, to cover the difference if it's a small amount, instead of doing a jumbo. That way they're able to get the pricing for a conforming loan versus that of a jumbo loan. But great question. Any others before I move on? Okay. All right, interest rates and fees. So rates and fees are typically higher on a jumbo than what you're going to see on a conforming loan. And the fees generally are represented, in the points and the cost for the rate. Again, 100% of the risk is on the investor on these programs, and so as a result, their rates, although still competitive, and they do follow the rate patterns of conforming loans. They generally are higher than what you'd see on a conforming loan. So just for example, if rates today on a conforming loan are 3.25%, a similar borrower profile, credit score, so on and so forth, amount down as a percentage for a jumbo loan might be, a quarter point higher. So maybe 3.5%, or they could buy it down a little bit to get, to 3.375, so on and so forth. Most jumbo loans, however, you are going to pay points for, regardless of the rate. They don't often have a par rate, meaning no cost for it. So their par rates generally still come with, a half a point to a point in cost. And again, part of that is the investor needs to make some upfront revenue on that mortgage, as the life expectancy of certain loans aren't super long. People generally are refinancing after 5 to 6 years, and since 100% of the funding and backing of those funds come from that investor, then part of the way that they are able to make these types of loans and make money off of them are the upfront points and costs for these loans. That's not always the case, but a lot of times you'll see that. Loan limits, so investor specific. Now, a lot of factors go into it: credit scores, down payment amount, location, occupancy type, primary versus second, and investment. So these factors and others will go into what the loan limit is on certain programs for jumbo products. And again, when I show you some examples, you'll see some of those fluctuations in jumbo products loan limits. Any questions here? Okay.
I had one.
Oh, sure.
We talked about it a little bit when you're helping me out, but my last refinance was through Wells Fargo, and they always are advertising lower rates with their jumbo loans than they have with their 30-year fixed loans. And I was just curious, is that why would they possibly be doing that? Or do they make up for it with points or something?
Yeah, sometimes. So a lot of times they make that up in points and fees on the back end. Plus, certain banks will sometimes offer those kind of things as a way for them to attract a specific type of customer. Because for the bank, they're not looking just to get your mortgage. They want your checking account, they want your investment accounts, they want your credit cards, and they're going to make money off of all of those products. So they will set their guidelines for that product for sort of the top tier clientele, and sometimes they will discount, they will do a discount for that, in terms of a rate as a way to attract those clientele. So they want that 780 credit score person. They want the one with reserves for with 18 months reserves, so that they can attract all the rest of that business, not just the mortgage. So it goes in waves, also depending on their appetite, on whether or not, and this is sort of bank specific, bank in general. And it goes sort of in waves depending on what their appetite is. You'll see them bring their rates up sometimes when they want to slow down that business, because they have sort of control over that. So, but great question. But often there are points included with that upfront on there. I've seen it sometimes though, where they have, if somebody opens up their Wells Fargo investment account there, I can't remember what, Wells Fargo Advisors, I think is what it's called. If you open an account there, they'll sometimes discount those points by like a quarter point or something. So
Okay.
Yeah, since they have that, and they're able to control that because they have, all those other products they want to make money off of.
Sure. Okay.
So, great question.
Thank you.
Here's an example of one of our jumbo investors. So right now we've probably got 10 of your typical conventional jumbo investors. Example of this one is their max loan amount is going to be $2 million. You're allowed to go up to 85 to almost 90% loan to value. So they won't let you go 10% down, but they'll let you go 10.01% down. But they cap the debt to income ratio when you go over 85% loan to value at 35%. So if you're going to put less down, then they want to see that you have less debt and that your debt to income ratio is better, is lower. And then also the loan to value is going to be capped depending on your credit score as well. So if your credit score is between 680 and 699, then then you'd have to come in with at least 20% down. 700, they allow you to go as low as 15% down, and then at 740, you can get to that almost 10% down option for this program. For this one, you can go primary, secondary, and investment property, although they do have a lower loan limit for investment properties. $1 million is the top. Reserves they require, and there's a lot that goes into this, but they require 6 months to 30 months per property owned. So if you're somebody that owns 5 properties, then you're going to have a lot more reserves left over than somebody that's just buying the one property. And part of the reserve requirements going to depend on that loan to value up above. So if you're doing the least amount and you're just putting 10% down, the 10.01, then you're going to need more reserves. You're going to have to get to that 30-month reserve mark rather than somebody that's putting down 20% down, and they would only be required to put down 6 months or show 6 months of reserves. And then, of course, there's, in between there's 18 months, 12 months, 24 months, depending on the different criteria. But again, reserves being money left over after closing. With this program, you can buy a primary residence. They only allow for 1 unit, that we can't buy a multifamily property 2 to 4 units. It's just a 1-unit property. It can be a condo, it can be a PUD. And then second home investment properties are allowed as well. No manufactured homes on jumbo products. In general, there are some investors that'll do them as sort of your non-conforming, non-conventional type lending, much higher priced, however. Let's look at example number 2. Also a max loan limit of 2 million. And depending on the property. So this program, it allows you to do a 2 to 4 unit property. So up to 4 units, but your loan to value max, you'd have to bring at least 30% down for that. For a 3 to 4 unit property, you have to bring at least 25% down if you're doing a 2 unit property. And then you can go at 80%, so 20% down on a 1 to 2 unit property. So you're going to have a max debt to income of 45, 40, and 38, depending on your occupancy type. For investment, again, they want to see a lower debt to income score, or sorry, lower debt to income ratio, to make sure that your cash flow is strong and won't have problems. Minimum credit score in this program is 680. It's not staggered like the other program was, and part of the reason for that is they cap you at 80% loan to value. So you don't have a 15 and 10% down option. You're capped at 80%, so 20% down. Primary, secondary, and investment still allowed. Reserves in general are 6 to 18 months, depending, and that's per property owned. Could be more if you own additional properties as well. However, 1 to 4 units are allowed, condos again, and PUDs. This last one here that I'm showing as an example, this is our 5% down jumbo program. This is a great loan. I've done this loan now 3 times in this last year, and it's an awesome program, although it does have its unique restrictions that that the investor wants that you have to be careful of. So with this one, the max loan amount isn't quite as high. So if you only want to do 5% down, your loan limit is going to be 850,000. Still pretty big loan for only 5% down. And that's where we have seen the most activity on this loan, is with the 5% down option for those folks that are buying over that 548,250, where it doesn't make sense to do a second HELOC. It makes more sense to do it all on one loan. This program has come in really handy. Max debt to income is 43%. And how does that compare to a conforming loan? So conforming loan, when you're staying under that 548,250 amount with good credit, you can go almost all up to 50% debt to income. So 49.99% debt to income. So you've got more flexibility there. With this program and most jumbos, however, they're going to cap you at 43, maybe 45% debt to income on certain products. But with this one, on the 5% down, they're going to cap you at 43%, which is still pretty generous for a 5% down jumbo. Credit score 720, 740, depending on the rest of your borrower package. But you can do the 5% down at the 720 credit score. Primary only, so there's no option on this program to do a second home or an investment property. Reserves are generally 6 to 9 months for property owned. Additional may apply, again, depending on the circumstance. For this property and for most jumbos, you're looking at doing sort of your regular properties. You're not looking at properties that have a lot of acreage, although you can go up to 20 acres on most of these products, including this one. The predominant value still needs to be in the home. So if you find a property and it's got a 600 square foot house on it and they're selling it for $1 million, the property is carrying most of the value likely in that purchase, and a lot of jumbos aren't going to approve it because the predominant value is not in the home, it's in the land. For a remarketing, and that's a lot of what the jumbo programs base their guidelines off of, is the remarketing of a property if they were to repossess it. And what they're going to look at is, okay, if we had to repossess this property, what would it take for us to get it prepared to get back on the market and get rid of it before we lose even more money? And so if you've got a unique property with a lot of acres, several outbuildings, and the possibility for what they would call multi-use, then they may not be interested in it. And the reason for that is because the cost to rehab that property and remarket it back out to the public once they've repossessed it and had to already lose a lot of money on it is much greater. So your jumbo products are going to be for for sort of your regular type of homes. In this one, I actually ran into that problem with this exact program right here, where somebody's doing 5% down. The loan was $785,000, and there were several outbuildings. Property was less than 5 acres. It was his primary residence, but because there was a ADU on it, it was a permitted ADU. It was done properly. Everything was nice. The previous owner also had installed a koi pond in the back, and it was selling koi out of there. And the property a couple doors down across the street was a feed store. And so the investor on this program was giving us a hard time about it because they were trying to call it a multi-use property, thinking this guy was going to go sell koi or something once he once he bought the property, and turn the ADU into an Airbnb or something. And part of the problem is we had to show that this was not a uncommon property for the area. For the area, this type of property was pretty typical. There was a lot of properties that had not necessarily koi ponds, but permitted ADUs, less than 5 acres. And it was okay that there was a feed store a little ways away, because a lot of people had, horses, and this one also had a horse barn. And so with a lot of hard work and convincing and pulling in the right people, we were able to get them to reverse that decision and approve it, which was great. But those are the kind of things you got to be careful of when you're doing jumbo products, is to make sure that the property, not only will your borrower qualify, but is your property going to qualify either. If you see, a property that somebody, has decided to plant a bunch of grapes on it, because they decided they wanted to live in, and have a little vineyard on their property, a lot of jumbo products will lose their mind when they see grapevines. So although it may be for personal use, and it's basically just a different type of plant in a garden, they may reject it based off of that. So you got to be really careful. Definitely, if you're doing a jumbo loan, make sure you are connecting with your lender closely and letting them look at the property, especially if you think there's any question or it's a little unique, to make sure that they don't think they're going to run into a problem with it.
That was part of what I was just going to ask you. So you would suggest going to the lender that you're working with to evaluate the property, or should we as agents kind of evaluate it on our own and deal with our clients?
I would evaluate it on your own, and then send a Redfin link or something to the lender and say, if you're looking at properties that might have some, uniqueness like that. I mean, if you're looking at a house, in a typical subdivision, where where those types of things aren't an issue, then it probably doesn't matter. But if you've got a property that's pushing the boundaries a little further out, or even in town, an example is as neighborhoods convert from residential to sort of these mixed uses, to where commercial starts encroaching upon the residential, then you may be careful about those as well. If you've got 5 or 6 homes on the property that have been turned into insurance agencies, insurance agent offices or something like that, and you're wanting to buy a home in the middle of those, then you've got to be careful for those as well, because the zoning may have changed. And it's a lot of times what you'll see is, if the home remains a residential home, then that's fine. But if somebody were to change it to a commercial venture, and then it can never get changed back to residential. Or an appraiser may go in and say the highest and best use for this property is commercial, then you may run into a problem as well. So definitely, especially when you're doing jumbo, and your properties might be a little unique, then definitely work with your lender. Say, hey, we're looking at this property. Can you take a look? Do you think we're gonna have any issues with it? And they should be able to take a look at it and review it, and and give you their feedback on it. So yeah, absolutely work closely with them. What else? What other questions are there? That's sort of jumbo lending in a nutshell. Tanya, you got any feedback on past deals maybe that you've had?
You know, when I was on the Clark group, I worked with we had some jumbo loans, but I personally haven't. Of course, I lived in Montana when I was really selling, and you know, price point there is a lot different than it is here. At least it was, 10 years ago.
Sure.
But you had some really great examples. I like that too. Like, and on the one that you said, if there's vines, grapes, right, on the property, even if it's like a 20-acre, what if there's not, but your buyers are going to want to plant some just for themselves? Is that going to be an issue after the fact?
No, nobody's gonna come check on them.
I will.
Yeah. Well,
So I can taste
you
it.
may. No, nobody's really gonna care at that point. As long
It's
as
just they don't want it there,
you're
then
making
they
your
buy it.
payment.
Right?
Mhm.
And if there is, after the fact, it'll just help you pay for it, right?
Right.
No, Josh, I like this, and knowing the differences in the jumbo loans, right? And knowing where the price point is, if your people can't qualify for it. It's great to understand and know if they're going, hey, we want to buy an $800,000 house, that'll trigger you. What's your down payment? And then have you talked to your lender and what type of loan are you doing? Because then we need to look at other things.
Yeah, absolutely.
So I have Josh come on these to teach these things to you guys so that you know what to look out for. Like, it's not our job to know all these fine details. That's Josh's job, right? But
Right.
it's our job to understand and know what to expect when our clients say, I'm buying a certain price point, or I'm using a certain type of loan, because it can change the whole picture for us on what they're actually able to get.
Yeah, absolutely. I mean, it's just, there's so many different programs and the different, and some of them limit how many homes you can own. I had one right now where I was going to use a program for a jumbo borrower doing $1 million loan, and but she owns, once this loan closes, she'll own more than 4 properties, and the program that we were originally going to use only allows up to 4 properties. So we had to switch to a different one that allows up to 6 properties. Yeah, it's
It's really, really important to make sure that you are in a conversation, not just with hey, Brian, not just with your buyers, but also with the lender that your buyer's using, so that you can ask those other questions that your buyers might not be asking, or that your lender, you can talk to the lender about what they're telling you they want to look for, so that you're both on the same page, and you can get a better understanding and help your clients the best possible way.
Yeah, absolutely. What I've found a lot of agents will ask is, what are they pre-approved for? Well, that's often a sliding scale, and that max amount, may change depending on the property and, and the program. So especially if they're really close to, the limit on a certain type of program, if they go over that, is there another program available to them? Can they switch to a first and a second? Just sort of knowing what that person's flexibility and options are, doing that work up front is going to cause a lot of headache and heartache later if it's done properly.
Right.
Yeah, absolutely. So, well, cool. Well, any other questions for me? All right.
Kristen, got any?
No.
Good.
All right.
Josh?
Well, if there are any, obviously you guys know where to find me. So
He's next to me.
you want me to send my slide deck to you, Tanya?
Yeah, send it over. We'll share it in the group under the masterminds, and then we'll see you again on the mastermind on the 21st. We'll talk about those rural properties and other unique properties.
Absolutely, absolutely. So, all
Cool.
Thank you, Josh.
right,
Thank you so
thanks,
much.
guys.
Appreciate
Thank
it.
you so
Have a
much,
good day.
Josh.
Absolutely. We'll see you later.
Bye.
Bye.